language. But honestly, it's not as complicated as it seems. Today, we're going to break down the basic ideas behind every single policy out there. Let's jump right in. Have you ever tried to read an insurance policy and felt like your brain was short-circuiting? All those words like indemnity, peril, adhesion. It's a lot. But stick with me, because in the next few minutes, we're going to clear all that up and turn that confusion into confidence. Okay, so first things first. Before we can even really get what insurance is, we have to understand the problem it was invented to solve. And that problem, in one word, is risk. It's just a part of life, and insurance is a really, really smart way of managing it. And that's really it. That is the entire idea in a nutshell. Instead of you having to cover the huge cost of a car wreck or a fire in your kitchen all by yourself, you pay a small, predictable amount of money, your premium, to an insurance company. And in return, they take that giant, scary financial risk off your shoulders. You're literally transferring the risk. So let's get a little more specific. What exactly is risk? Well, it's just the chance that something bad could happen. It's not the event itself, but the uncertainty, the what if. And insurance companies are really only interested in what we call pure risk. That means there's a chance you could lose something, but there's no way for you to gain from it. Now, let's build on that. What's a hazard? A hazard is anything that makes that loss more likely to happen. So a wet floor doesn't mean you're definitely going to fall, but it sure does increase the chances, right? That's a hazard. In the insurance world, this could be a physical thing, like faulty wiring in a house, or even a behavioral thing, like being a careless driver. And that leads us to the last piece of this little trio, the peril. The peril is the thing that actually causes the loss. So if the wet floor is the hazard, the peril is the act of slipping and falling. See how they connect? Risk is the chance it could happen, the hazard makes it more likely, and the peril is what actually does the damage. You know, we all deal with risk every single day, whether we realize it or not. Sometimes we just avoid it, like never getting on a plane. Sometimes we hold on to some of it ourselves. That's what a deductible is. You're retaining a piece of the risk. And we try to reduce it, by installing a smoke detector. But for those really huge, life-altering risks, the smartest thing to do is transfer it. And that, right there, is why we have insurance. All right, so you've decided to transfer that risk. You sign up and you get an insurance policy. But that policy isn't just any old document. It's a really unique kind of legal agreement, and it's built on a few very important promises and principles. And this is maybe the biggest principle of them all. It's called indemnity. It's a $50 word for a pretty simple idea. Insurance is there to make you whole again, to put you back in the same financial spot you were in before the bad thing happened. It is absolutely not designed to be a winning lottery ticket. Let's look at a quick example. Let's say you've got a homeowner's policy and the coverage amount is $200,000. That's the most the policy will pay out. Okay, now imagine the worst happens. A fire. That's the peril. You file a claim, the adjuster comes out, and they figure out that the actual cost to rebuild your house exactly as it was is $150,000. So, how much does the insurance company pay you? They pay you the $150,000. Why not the full $200,000? Because of that principle of indemnity. The goal is to restore what you lost, not to give you a $50,000 profit. You've been made whole again. That's the promise. Now, this whole system is really built on a foundation of trust. And in legal terms, we call that utmost good faith. It's a two-way street. It means you have to be totally honest on your application, and the insurer has to be totally clear and honest about what the policy covers. If either side hides something or lies, it can make the whole contract invalid. And here's a really important piece of info that protects you. Insurance policies are what's called contracts of adhesion. That just means you get it on a take it or leave it basis. You don't get to sit down and negotiate the fine print. And because of that, the law is on your side. If there's any part of that contract that's confusing or could be read two different ways, the courts will always rule in your favor, not the company's. Okay, so we've talked about the what and the why. We get the problem of risk and we get how the policy solves it. But who are the actual people and companies making all this happen? Let's meet the players. When you're talking to an insurance agent, you're talking to the company. Their power to act for the company comes in three flavors. Express authority is what's spelled out in their contract. Implied authority is the stuff that's just common sense for their job, like collecting your first payment. And then there's apparent authority. That's what the company's actions lead you to believe the agent can do, even if it's not officially in writing. Now, the companies themselves aren't all the same. The two big ones you'll run into are stock companies and mutual companies. And the main difference is super simple. Who owns the place? Stock companies are owned by stockholders who want a profit. Mutual companies, they're owned by the policyholders, people like you. So if there are profits, they go back to you, kind of like a refund. You'll also hear these terms tossed around to describe an insurer's location or its domicile. It's actually really straightforward. If they're domestic, they're based in your state. If they're foreign, they're based in another US state. And if they're alien, they're based in a whole different country. Simple as that. All right, for our last section, let's pop the hood and see how this whole thing actually works. I mean, how can these companies take on billions of dollars in risk and not go bankrupt? Well, the secret is all in the math. And this is the magic formula, the law of large numbers. Think of it like flipping a coin. An insurer can't possibly predict if your house is going to have a fire this year, but they can predict with incredible accuracy how many houses out of a pool of, say, 1 million similar homes will have a fire. The bigger the group, the more predictable the future becomes, and that's how they figure out what to charge everybody. So you know how insurance applications ask 1 million questions about your car, your health, your house? Now you know why. They're not just being nosy. They're collecting data points to put you into the right group of people with similar risks so that law of large numbers can do its thing. But the system has one major weakness, and it's called adverse selection. Just think about it for a second. Who is most motivated to buy insurance? The people who think they're most likely to need it, right? If only the sickest people buy health insurance, or only the riskiest drivers buy car insurance, the whole system would get overloaded and fall apart. And that's where underwriting comes in. To fight against that adverse selection, insurers have to carefully check out each applicant. They might need to charge more for someone who is a higher risk, or in some cases, even say no. It's not to be mean, it's to keep the pool balanced so that insurance can stay affordable and available for everyone else. So there you go. You now know the rules of the game. You get risk, you get the promises in the policy, you know who the players are, and you even get the math that makes it all go. The next time you look at a policy, you won't just see jargon. You'll see a powerful tool that helps you face the future with a little more certainty. So go out there and be a smarter consumer.